Ladies and gentlemen, welcome to the special interview. Today we have a returning guest to the show, Craig Hemke of TF Metals Report, located at tfmetalsreport.com. And I got to tell you, of all the paid subscriptions out there, you need to pay and subscribe to TF Metals Report, the Turd Vault, because you're going to be going there and using it not once, not twice, but probably multiple times a day, because Craig is on these markets like no other person is, daily, day in and day out. And if you're learning as a new stacker, he also has a ton of information for free, so check out the site regardless. Craig, I'd like to thank you for joining us again on Silver Doctors.
Paul, thank you. I appreciate that endorsement. Yeah, I can't believe it, man. It's been almost 10 years. And I always joke that you look at what happened like to Bush or Obama, or even Clinton. They spend that 8 years in the White House. They enter as a young guy and they leave looking like they're ready for the nursing home. And I think that's what's happened to me. 10 years. But yeah, thank you for the endorsement. The site's, it's reasonable. It's only $12 a month. Mm-hmm. So it's about 40 cents a day. And I basically am your eyes and ears to the world. So that if you're out there trying to live your life, manage, everything that's going on, you don't have time to watch this crap all day, but I do. Mm-hmm. And so that's what, that's the main thing you get for your 40 cents a day. We're all kind of in the same boat, and we recognize we're in the same boat, fighting this global economic storm that keeps swirling, and so we're all there to help each other. And I kind of steer the boat as we go along. And anyway, I appreciate that. I encourage everybody to check it out.
Great. Now we do need good captains for this boat. That's for sure. Now, Craig, I don't know what I should be looking at right now because there's so much going on right now. I'm looking at the Middle East and there's not a lot of talk, but apparently the Taliban is claiming they just shot down a CIA plane or U.S. military plane. And yesterday on the Ron Paul Liberty Report, they were talking about 5 military aircrafts have crashed in Afghanistan just in January of this month. I'm looking over at China and the Wuhan coronavirus, and I'm seeing something that has the potential to spark off the global slowdown. But then back here in the States, we've got an election that we're starting to think about. At the same time, we're going through an impeachment. What is on your radar the most, Craig, and why is it on your radar?
All right, I'm going to go to the ultimate big picture because all that stuff matters. There's any doubt about it. The Mideast tensions that aren't going away. The virus that we have no idea how bad. Pray that it ends up being no worse than the SARS or the N1H1, that kind of thing. But yeah, that has a potential. Just to really disrupt the global supply chain. Look at all these Chinese companies and cities that are shut down, like through Valentine's Day, not just through the New Year holiday. So there's a lot of impact from all of these other things. But what I want people to focus on is the big picture, and that is global central bank, fiat money creation, debt monetization, QE, whatever you want to call it, and lower interest rates. It was the recognition that was coming last year at this time that led me to write a report called 2010 plus 9 that said, even though gold hasn't been above 1350 for 6 years, 2019 was going to be the best year for gold since 2010 for many of the same reasons that moved it in 2010. And for once, I was right. At least if you listen to the trolls. Anyway, the conditions that drove gold last year will continue to drive gold this year. It's not straight up. You're seeing that. It's always going to be kind of a 3 steps forward, 2 steps back whenever you're dealing with these, the derivative precious metals markets. But the overriding condition of liquidity crisis, debt monetization, and lower interest rates is what drove demand for gold, silver too, mining shares, all their forms, unallocated accounts, ETFs, whatever. That's what drove demand last year. That's what will drive this year. So let's kind of go with the big picture. A lot of, gold bears are trying to convince everybody that now gold's going to crash. And the only reason it has rallied recently is war fears and this virus stuff. But remember, before the virus hit, we were rallying the last couple of weeks after losing the war premium. And before Soleimani was killed back on whatever it was, the 3rd of January, gold had rallied 3% from December 20th on. And silver had rallied 9% from over about 4 weeks at the end of the year last year. So they were already moving up. And why? Because precious metals were anticipating this very loose monetary policy that's going to continue. And so you and I are speaking on the morning of the Fed meeting for January. Nobody's expecting a rate cut, and I'm not expecting a rate cut either. But the bond market's beginning to price one in. The 2-year note is now below 1.5%. Fed funds are effectively 165. The 10-year note is 161. So the yield curve's inverted again. The Fed will move, probably if it stays this way, by March. But even more importantly, Paul, again, big picture. A trial balloon was floated Sunday night in the Wall Street Journal. Again, think of the timing of this, 2 days before the Fed meets. That said the Fed is going to be considering interest rate caps, meaning pick a target, 1.5% on the 10-year. Anytime rate gets up above there or near there, the Fed will aggressively buy treasuries, monetize the debt, to drive bond prices back up and rates back down. Okay, that's extraordinarily bullish for the precious metals. It institutionalizes low rates. It institutionalizes negative rates and negative real or inflation adjusted rates. That's about as bullish as it gets, big picture for the precious metals. And so expect something about that in the FOMC notes and Powell's press conference on Wednesday. Expect that plan to come into shape sometime in the next probably 60 or 90 days. It's not a, just a accident that this was printed in the Wall Street Journal. And that provides, again, that big picture reason, not the, all the other stuff, the day-to-day stuff, war, virus, all that kind of stuff, data points, whatever. All that stuff helps on a, on an intraday basis. But in the big picture, that's what's going to be driving the metals this year.
Mm-hmm. And, when it comes to the Fed, it sounds like, what I'm thinking about is Japan, right? Because they were trying to cap the interest rates there. And, we can see that if the United States is turning in Japan, then essentially it's going to be decades of stagnation, and real interest rates, as you said, are going to be, even worse when we factor in inflation. Am I understanding that correctly there, Craig?
Yeah. Yeah. That's a good enough metaphor, I guess, for where this is headed. And again, think of it. I've since 2016, I don't want to make it sound like I've said this my whole life, but since 2016, when we first started seeing negative interest rates around the globe, and I should point out, we got to 17 trillion in negative yielding debt back in August. It went down to about 11, okay, as bonds sold off and interest rates rose last fall. It jumped by over $1 trillion last week. Biggest jump since 2016. And as of this morning, we were over 13 trillion again. Okay. Back in 2016, recognizing that, I said, you know what? This is negative interest rates are the greatest fundamental ownership rationale for physical gold and silver that man has ever created. Why? I think of it if, even not in the US, think of if you're a German, where now even the German government has put these caps on there. It used to be you could buy 15,000 euros worth of gold in a day and not have to give your name and everything else. Then they cut it to 10. Now it's 2. And people have seen the lines, the queue around the German bullion dealers at the end of the year of people wanting to buy as much as they could because they don't want, who wants the government to know that, So anyway, and why would you want physical metal if you're a German? Well, your currency is a euro. Well, look at the trouble that is still in after all these years because of, what's going on in Southern Europe and, everything else. And they're printing it like crazy, and the ECB is monetizing anything they can get their hands on. So 1, your currency is being devalued. And 2, your bank actually charges you to store your cash. I mean, it used to be, you parked your money in a CD or a savings account. The bank paid you for for storing your cash, right? Because then they were going to loan it out. But now you have to pay the bank. Why? How is that not, again, the most positive fundamental for then saying, screw this. I'll own gold instead. And, well, you got to pay to store gold. Well, so anyway, this is this movement toward this Japanification, as you might have called it, is institutionalized. It's not going away. It's only going to get worse. And again, at the end of the day, that just drives a constant bid for the precious metals in all their forms, not just physical metal, but the futures contracts, the unallocated accounts, the promissory notes, the ETFs, the mining shares, you name it. And that's the bull market that we're in, regardless of the day-to-day, shenanigans up and down.
Now, Craig, the last time we spoke, open interest was about 600,000, and you were like,
Yeah.
they're going to take it up to 800,000 if they need to. And sure enough, they took it right up to 800,000. So, it seems like, the powers that be are well aware that this is uber bullish for gold and silver. So they're just feeding and feeding and feeding and feeding paper in there. Are they going to take open interest up to 1 million? Silver's also getting close to its all-time open high in open interest. So could you just talk a little bit about open interest and what's going on with the latest efforts to contain these rallies as gold and silver look like they keep one advancing here?
To answer your question, yeah, they'll take it to 1 million if they have to. I mean, there's no constraint. The banks can create the contracts, taking the short side and selling them to the longs to meet their demand, these speculating hedge funds or whatever. The speculators buy that on borrowed cash that they don't have, thus meaning at some point they have to liquidate them, and roll them to the next month or whatever. And they never demand delivery. And so the banks can just issue the contracts knowing they never have to make delivery. And at the same time, they're not subject to the same margin pressures you and I because they're too big to fail, right? Okay, so there's no question. I mean, it was 600,000. I mean, go back to back when gold was at, in 2011, open interest back then was routinely around 500 to 550,000 contracts. So now here we are, 9 years later, and it's 800,000 contracts. If anything, it's a reflection of what I just was mentioning, demand for precious metal in all its forms, whether it's just simply exposure to the price or some form of the metal itself. What people need to understand, the pricing system is fundamentally flawed and unfair because instead of trading physical metal, you give me, sorry, I got an itch in my nose, you give me some cash and I give you physical metal, okay? Instead of that relationship determining the price, so there's a kind of a supply and demand feature, okay, of actual physical metal. Instead, it's a relationship in the futures market and all this pretend metal that determines price, and the supply and the demand of the futures contracts and the pretend metal. And that's, again, that totally skews the economic reality of how much actual metal there is. We're seeing this now after decades, well, at least a decade or decades of this in palladium. You're now seeing the impact of mispricing the metal below what is the economically reasonable price to bring in extra supply and that kind of stuff. And so now we have a supply shortfall after all these years, and you see what's happening in price. Again, that's the flaw in this fractional reserve digital derivative pricing scheme that we have. So to take advantage of that, and again, it's why do the banks do it? Because they make a shit pot of money doing it, Paul. Sorry, I'm swearing now, but I'm getting all worked up. I've had a lot of coffee. Anyway, they make a lot of money doing it. That's why they do it. And they know, on balance, if they can issue enough contracts to the point where spec buying is absorbed, and then you can tip the market over, maybe paint a head and shoulder top on it like they did last fall, or break it down through the 50-day. Then all of a sudden the specs head for the exits. As they are selling, the banks are buying, covering back up the shorts, and putting the open interest back on the shelf and closing it out. It's a game they play. Mm-hmm. Now, knowing that impacts price. That's why price, we're 1570 or whatever this morning. I think now that we're above 1550, and that's significant, I think the target becomes 1650, and maybe from there 1750 this year. A lot of folks, gold's going to two. Maybe, but it's going to be a tough slog just because of that supply of all of this pretend gold that the banks force upon everyone.
Mm-hmm. And just kind of like a follow-up as far as the supply and the demand fundamentals. A lot of people are saying that this Wuhan virus at least last week, people were saying that this coronavirus could kind of like negatively affect demand in China. But I'm thinking, well, if people aren't traveling, if Disneyland is closed, if there's all these restrictions, well, the Chinese save in metal. So it could actually have the reverse effect and cause an increase in actual physical demand because of the fact that we're not going to be using this as disposable discretionary income. Rather, we'll just save it for something else in the future. So I find that very interesting. But the bottom line is they'll just keep on feeding that paper in to stem any kind of price rise, just to keep it at bay.
Yeah, and the Chinese markets are going to be closed this week for the New Year holiday anyway. So, and you can see that. You can see, like the Asia Open that happens at 8 o'clock Eastern every night here in the States. You can see the lack of that extra. And I would also point out, have you seen Bitcoin this week? You want to talk about, people sitting in their apartment buildings in Beijing or wherever with nothing to do and thinking, how am I going to buy anything if I can't get to the bank? There's a reason why Bitcoin's rallying on this too. But anyway, yeah, I'm sure that could very well have an impact, positive or negative, about more people trading and that kind of thing. But at the end of the day, it's all about the banks managing the paper market in New York and the physical market in London. If anybody doesn't understand that or think I'm, spouting hogwash, go back and look at the indictments, the RICO indictments that came last fall, most notably of Michael Nowak, head of global precious metals trading for JP Morgan. He was indicted for spoofing and manipulating the markets, but hopefully folks noted that Michael Nowak was also on the board of the LBMA. So why would the head of global precious metals trading in New York be on the board of the LBMA, where the physical delivery takes place in London? Because those two desks are hand in glove, and that's how the banks work to manage price.
Now, staying on the metals here for a second, and you have brought up palladium because you said that palladium might be causing some problems because of an underlying shortage, and I think you said, selling metal underpriced by essentially supplying the paper. So could you just explain that a little bit more for our viewers and our listeners as far as what is palladium signaling and why should gold and silver investors be paying attention to it? Because also another thing, palladium's the only metal that's up right now and all the other three precious metals are down. So what is going on with palladium that's different, and should we be paying attention to it with more detail?
Well, no, hold on. Gold's up about 4% year to date, Paul. So.
Oh, okay. I meant today. But anyway.
But you look across the board. I agree. Look, palladium is clearly in physical shortage. How do we know that? One, the backwardation of the futures board, meaning the spot contract is trading about $100 above the nearby futures contract. It shouldn't be that way. It should be a contango. It should be the other way around. That's how futures are supposed to work. And any backwardation is always a sign of a physical supply issue. We also know in London, where these banks have to deliver physical metal, lease rates got as high as 35% last week. Okay, what that means is that's an annualized rate. If I have no physical metal, if I'm on the hook, pick a bank. We always pick on JP Morgan. If I'm JP Morgan and I had issued a promissory note to you for 1,000 ounces of palladium due today, and let's use last week because that's when rates were, say, 36% annualized. That's 3% a month. And I needed 1,000 ounces to deliver to a client today because I've got this contract that says I'll do it, and I don't have it. So I come to you, Paul, and I say, Paul, loan me 1,000 ounces of that palladium you've got. Well, because you don't know if I'm going to be able to get it back, you charge me some exorbitant kind of Shylock level rate, right? 36%. It's not payable in cash, though. So I'm creating a compounding problem for myself because I'm going to borrow your 1,000 ounces, and I'm going to pay off the guy that I got this note with. But a month from now, when I've got to give you back your 1,000 ounces, I've got to give you back 1,030. Okay, that's the 3%. That's the 36% annualized. Well, that dog ain't gonna hunt very long, man. Okay, that's compounding the problem fast. So those lease rates like that spike like that are another clear indication of a physical supply squeeze. We've seen reports from Scotiabank that say the above ground stocks of physical palladium may be entirely exhausted by this summer. Okay, so now all of a sudden, this is not a paper thing. This is the banks aren't issuing contracts on the COMEX trying to manage price. Actually, COMEX open interest has been flat now for several years, hasn't really changed at all. And the positioning hasn't changed. It's not speculators driving price. It's a physical demand problem. And why are we running out of physical palladium? It's like any other good. I guess maybe I take for granted that a lot of people have taken econ classes at some point in their life. But if you've ever taken an econ class in college, you remember there's a supply curve and there's a demand curve. And where they intersect is the equilibrium where you'll find price. Okay. But if I've got a supply of a good and I continually market below that equilibrium price, the supply is going to be exhausted. It's like if, say, I've got a car lot full of cars that are worth $20,000 and I instead price them all at 10. People are going to come from all over town and I'm not going to have any cars left, right? I mean, that's just how it works. So when you misprice a good, supply gets exhausted. And in something like a metal, there's no incentive to mine palladium. There's no incentive to open new mines. Projects are uneconomic below a certain price level where palladium prices were for more than a decade, all through from 2001, it spiked to 1,100 under similar conditions. Then went down to like $300, $400, $500 an ounce for over a decade. And that meant you draw down in physical supply, much like we're eventually going to see in something like silver too. So anyway, moral of the story is we are almost out of physical palladium, but this market that prices it in New York and London is set up the same way that we just talked about with gold and with silver. And so now there's a real squeeze, a real problem for the banks. They have to meet demand of physical palladium through all these promissory notes and leases and all the other same stuff, like I said, that the way they structure gold and silver, and they're increasingly not able to do it. So the chart, I mean, we're in the middle of a 10% pullback in palladium since last week. We've had 6 of those in the last year. And all it's done is set the stage for the next move higher. You look at rhodium. Rhodium doesn't have a futures market. It's now approaching $10,000 an ounce. This is going to be a big story this year. I don't see a way out for the banks. What will probably happen is it's some type of default by summertime. This doesn't come without precedent. People look up the Maine potato or whatever it was called, the Maine potato default of the 70s, a futures market that couldn't deliver at the price. It had to close. They had to cash settle everything, and then it just went away. And it was big news for like a day. My fear is that palladium will be a big news for like a day, and then it'll just go away. What we want to have happen, Paul, is we want gold and silver investors, not you and I. We know how the crap works. We want hedge funds. We want Ray Dalio and Stanley Druckenmiller and all these people that own gold, the GLD and stuff like that, and think they own gold, to see what happens in palladium, understand what happened and why it happened, and then go, wait a second, hold on just a minute. Are your gold and silver markets structured the same way as palladium? You pull the same shit there I want my gold now. I don't want this unallocated stuff, at the Perth Mint or Kitco or all these places that own these unallocated accounts, just-in-time delivery if you ever want it. I don't want something at UBS. I want my gold now. And then you start getting into the same type of chart that palladium has.
And here's why that seems such like an important point for me, because I'm thinking of it like this, the way you're describing it. It basically comes down to the fact that if people are for cash settled, if they're force settled, or force majeure, if they're cash settled, well, that means that they're getting settled at that price. And let's call it gold at 1,500. And at that point, the cartel knows it's lost control. So they're just going to force settle everybody. So if you don't have it, if you don't hold it, you don't own it, you're going to miss out because, once the price starts moving, well, you got cash settled at 1,500 and now all of a sudden gold's $3,000.
Right.
So that's the importance of actually understanding the difference between paper and metal.
And understand, again, I can't make this point strongly enough. The market structure of palladium and how the banks run it is identical, okay, between the COMEX, CME, and in London. It's the same crap. Look, I've written now for a couple of years about this use of this kind of arcane market, feature called the exchange for physical. Okay. It was written into commodity law that if, you own a commodity contract, you kind of work with another party and exchange it for actual physical commodity. Well, it's not supposed to be abused the way the banks are abusing this now. Over the last 2 years, just 2 years, if you add up all of the COMEX gold contracts from a daily basis, which I've done, that have been allegedly exchanged for physical, the total exceeds 14,000 metric tons. What's the U.S. allegedly hold? 8,000? Okay. There's no way this is happening. Andrew Maguire told me that what the banks do is they just go into this black hole in London of rolling 13-day forward OTC things that are off the books and never get, and they just kind of keep them all in limbo. Okay. Now, if you understand that that's bullshit, last week I started looking at the EFPs for Palladium because it's the same thing. In Palladium, there were 3,200 exchanges for physical in 5 days. 3,200 contracts. Just as in gold, each COMEX contract is 100 ounces. Okay, so that's 320,000 ounces allegedly exchanged for physical. Well, where? Well, COMEX vaults only have 38,000 ounces. Okay, so nobody's exchanging a COMEX contract for physical metal in New York. So it must be happening in London. But there's no metal in London either. We know that by the lease rates. So this is just all these shenanigans. Cash settlement, just trying to anything they can to keep all these plates spinning without them dropping. It's the key, like I said. Palladium may get everybody get cash settled. It's a little itty bitty market. People begin to transfer into platinum, whatever. And it may be news for a day and a headline on Bloomberg that's, somebody that fancies himself an expert suddenly will talk about. And then it may just go away and nobody will ever give a shit ever again. So what we need to do is make sure when this finally happens, that we shout from the rooftops, this is exactly the risk you're taking if you don't hold in your own two hands physical gold and silver. And it's that's going to be the moment of truth. And it's I don't see how it's not coming sometime later this year.
And wrapping it up here with the last question, Craig. Just want to get your thoughts on silver. We talked about, the economy in general. We talked about gold. We talked about palladium. 1750 seems to be holding. It's kind of weird, though, talking about silver under $18 here in 2020 with so much debt that's being created. Yeah. But just, at least it seems like 1750 is holding. Just what is your outlook for silver? If you could share any of your outlook for silver with us and any other insight that you would have for the silver stackers out there.
Well, I'm not looking for any moonshot at this point. It could happen. Back in 2010, that's what happened. Once we got to QE2, that was when silver went from 18 to 48 in 8 months. Okay, so a move, from these price levels up could have, wouldn't be unprecedented, right? But we know the banks are going to fight us every step of the way. I would think something more gradual is in store because the dollar looks like it's rolling over. We know about interest rates, all the stuff that you and I spoke of at the beginning of this call. There is a clear resistance area on the chart. It begins at 1820, which not coincidentally was the low for price June 26th, I think, 2013, after we smashed down through 26 and then further sold off in June. We bottomed out, Paul, 1818. So there's not 1820 has been a significant level ever since. Anybody can pull up a chart in the last month and you can see how important 1820 is. But I guess more significantly, what we're waiting for is a weekly close above 1850. We've had some intra-week trading as recently as a couple of weeks ago where we've gotten above it, but we've fallen back. We haven't actually closed above 1850 for years. So we get above there, that'll start getting some positive attention and momentum, and then 20 comes into view and maybe even 22, but that's not going to be easy. Gold, like I said, is moving up. 1550 was a very important level on a weekly basis. We've gotten above there now, I think 3 or 4 weeks in a row on a weekly closing basis. That opens the door for 1650, which we've been talking about on my site now for several months. Above there, we could see 1750 or 18. I think there's a much higher likelihood that gold sees 1750 to 18 this year than silver sees 22. So I don't mean to make people, silver stackers go, God, just understand. This is only giving you more time to average in. I know it's been very my I've got silver I bought in 2010 and 11 at $30 an ounce and $40 an ounce. But since I've been buying it every week and month or whatever since, my total cost basis for all of my silver that I hold all around the planet is about 18. So, if you keep buying it, you're averaging down. Eventually, it's going to, I mean, it may take a while, but what's going on in palladium? Long answer to your question. I wouldn't expect spikes this year unless all hell breaks loose, but I would expect a continual gradual climb. And as asset allocation, global asset allocation from institutions, hedge funds, individuals alike, goes from below 1% to the precious metals as it is now to even just 2, that's double the amount of cash chasing what is basically a finite amount of investment opportunities. Things are going to go higher, particularly the mining shares.
Craig Hemke, I'd like to thank you for joining us again on Silver Doctors.
Hey, my pleasure, my friend. Let's do it again sometime too. Let's do it again sometime soon.